Kia ora, I'm David Chaston with 90 at 9, brought to you by interest.co.nz. This week, get everything you need to know in 90 seconds at 9 o'clock with news the Russians and the Chinese are coming. But first, this is a public holiday in the US, Independence Day, with everything there essentially closed until Wednesday New Zealand time. China's also essentially closed as they take time out to celebrate the anniversary of the Chinese Communist Party and fawning over Chairman Xi. Taking advantage of the holidays have been a ransomware group who launched a massive strike over the weekend affecting thousands of organisations worldwide, including in New Zealand. No one actually knows where this threat originates from, but they're thought to be based in Russia because the group does not target Russian organisations, nor those in the former Soviet bloc countries, nor China. We can use this break to note that our investment portfolios are likely to have a growing portion of Chinese debt investments in them as China gets more comfortable about its financial market opening up. Benchmark Chinese debt still has relatively high yields. Their government 10-year bond yields at 3.11% today, giving an attraction to many fund managers with the added prospect of large capital gains ahead as it reverts to much lower global yields. At the same time, China is keen for its domestic investors to go international. That is because without a two-way trade, their currency would likely strengthen sharply. Sharper funds outflows from China may be a feature of the post-COVID investment scene. In the US, non-farm payrolls report beat expectations, rising 850,000 in June from May, when a 700,000 rise was expected, and the May rise was revised up to 583,000. But these are essentially seasonally adjusted numbers. The raw numbers have been far more favourable in the prior 2 months, basically gaining 1 million each month, with payrolls rising from 143 million in March to 144 million in April to 145 million in May. In June, they actually rose to well over 146 million, a gain of 1.1 million. These are all far better than the statistically adjusted levels. In a year, US non-farm payrolls have risen more than 8 million. However, compared with June 2019, they're still more than 5 million lower. So while recent trends may actually be better than generally reported, they still have a very long way to go to recover pandemic losses. It is this overall gap that has bond investors starting to think the US Fed is probably a long way off raising their policy rate, further away than what analysts had previously assumed. In Australia, bank mortgage lending to investors hit a 6-year high in May, up a startling 13% from April and up 90% above May 2019. This is its strongest rise in 6 years. US Treasury 10-year yield starts today at 1.43% and down 11 basis points in a week. And the price of gold is now at $1,787 an ounce, which is down $4 from this time on Saturday and unchanged in a week. And oil prices are unchanged. In the US, they're still at just under $75 a barrel, while the international Brent price is just on $76 a barrel. However, at these levels, they now exceed the 2018 peak and back to 2014 levels. And the Kiwi dollar opens today just on 70.3 US cents and holding its Saturday rise. But compared with this time last week, it's still 40 basis points lower. Against the Australian dollar, we're little changed at 93.5 Australian cents, and against the euro, we're unchanged at 59.3 euro cents. That means our trade weight index starts today unchanged at 73, but 50 basis points lower than this time last week. Kia ora, I'm David Chaston. That was 90 at 9, brought to you by interest.co.nz.